There's a very specific reason why most people who invest in AI stocks never make the kind of money they were expecting to. And it has nothing to do with picking the wrong company or getting in at the wrong time. It comes down to something much simpler. They are betting on the wrong part of the machine. Right now, there are 6 stocks sitting in positions that most investors are completely overlooking. These are the stocks tied to what Wall Street calls the bottlenecks of artificial intelligence, the scarce, critical, high-demand parts of the entire AI ecosystem that everything else depends on. And when something is scarce and demand is surging, the companies that control it print money like nothing you have ever seen. Stay with me, because by the end of this video, you are going to understand exactly why these 6 names could be the most important investments you make in the next several years. If you are new here, hit that subscribe button right now and turn on notifications. At Ticker Hawk, we break down the stocks that actually matter, the ones with real numbers behind them, not just hype. And trust me, the numbers we are about to go through today are unlike almost anything we have seen in the history of the public markets. Let us get into it. Here's the thing about AI that most people miss. Everyone talks about it like it is one giant category. Buy some AI stocks, hold them, and wait to get rich. But the smarter move, the move that separates serious investors from the crowd, is to follow the bottlenecks. A bottleneck is the part of a system where demand is massively outpacing supply. It is the narrow point in the pipeline where everything slows down unless more of it becomes available. And when a company controls a bottleneck, they get to name their price. Customers cannot say no. Contracts get signed for years. Margins go through the roof. And the earnings reports start looking like something out of a financial thriller. That is exactly what is happening right now across a very specific set of companies. So let me walk you through all 6, starting with what I believe is the single most urgent bottleneck in the entire AI stack right now. The first stock is Micron Technology, ticker symbol MU, and the bottleneck it controls is memory. Now I know that word might sound basic, but high bandwidth memory has become one of the scarcest and most critical resources in the entire AI supply chain. The biggest AI models running in data centers today require enormous amounts of memory on every single chip, and demand is not growing slowly, it is exploding. The next generation of NVIDIA chips is packing in roughly 10 times the memory of the generation before it. That kind of demand surge puts extraordinary pressure on the few companies in the world that can manufacture this memory at scale. Micron is one of them. Here is where the story gets powerful. Micron does not have enough factories to keep up with demand. That sounds like a problem, but it is actually a gift because when supply is tight and demand is surging, prices go up. And when prices go up in a business like this, margins explode. Micron went into their most recent earnings expecting about $33.5 billion in revenue at 81% gross margins. What they actually delivered was $41.5 billion in revenue at 84.5% gross margins, $35 billion in gross profit alone. Just 1 year before that, Micron was doing $9 billion in annual revenue total. Now they're doing over $41 billion in a single year. That is more than 350% growth year over year. Net income went from $1.8 billion to $28.2 billion. Free cash flow hit $17.5 billion, more than 3 times what it was just 1 quarter earlier. Cash on hand climbed to $26 billion, while debt was cut from $15 billion down to $5 billion. What really locks in the long-term story for Micron is the contracts. They are signing 3 to 5 year agreements with some of the world's largest technology companies. If a customer wants to cancel, they still owe Micron tens of billions in penalties. This is not a hot quarter. It is a structurally locked-in revenue machine. Management has stated that supply and demand for both DRAM and NAND memory will remain tight beyond 2027. Next quarter guidance is $50 billion in revenue, 86% gross margins, and $31 in diluted earnings per share. 1 year ago, that EPS number was $2. And let that sink in for a moment. Drop a comment below and tell me which stock on this list you're most interested in. It helps the channel, and I genuinely read every single response. Now let us move to the second bottleneck. The second stock is Lumentum Holdings, ticker symbol LIGHT. This one is earlier stage, which is part of the opportunity. Lumentum manufactures the photonic and optical components that allow chips to communicate with each other at high speed inside data centers. As AI systems scale in complexity, the volume of data that needs to move between chips, between racks, and between servers is growing at an almost incomprehensible rate. The companies building the most advanced chip architectures today are consuming more optical components than ever before, and Lumentum is at the center of that supply chain. Revenue growth has surged from around 18% a year ago all the way to 90% right now, bringing total revenue to around $800 million. Their systems revenue has more than doubled, growing over 122% year over year. Gross margins have cleared 46%. The company has posted 4 straight quarters of profitability. Free cash flow is at new all-time highs, growing over 266% year over year. And their Rule of 40 score, a metric that combines growth rate and profit margin, has gone from below 40 just 1 year ago to 126 today. That kind of acceleration in a 12-month window is genuinely rare. As AI infrastructure spending scales up, optical demand will only intensify. Lumentum is quietly positioning itself as one of the most important suppliers in the AI build-out. Now let us talk about the most visible bottleneck of all, compute. And the first name here is NVIDIA, ticker symbol NVDA. I want to go deeper than the headlines because I think most investors still underestimate what is actually happening at this company. Last quarter, NVIDIA delivered $81.6 billion in revenue at 85% growth year over year. And here is what makes that remarkable. NVIDIA was already the largest company in the world by market cap when those numbers came in, and they still re-accelerated revenue growth from 55% back up to 85% in a single quarter. Some analysts are now projecting that next quarter, NVIDIA could cross back into triple-digit year-over-year revenue growth while being a $5 trillion company. That has essentially never happened in market history. Data center computing revenue was $60 billion, up 77%. But data center networking revenue, the cabling, the switches, the infrastructure connecting everything, nearly tripled year over year to $15 billion. Gross margins remain above 75%. Free cash flow hit $48.6 billion, a new company all-time high. Projections suggest NVIDIA could surpass Apple as the highest free cash flow business in the world as early as next quarter. And management has stated publicly that hyperscaler capital expenditure is expected to exceed $1 trillion in 2027, with AI infrastructure spending on track to hit $3 to $4 trillion annually by end of decade. Everything we are talking about in this video flows from that projection. If you are finding value in this breakdown, please hit the like button. It genuinely helps more people find this content. Now let us talk about the fourth stock on this list, and this one is Broadcom, ticker symbol AVGO. I am including Broadcom alongside NVIDIA rather than instead of it because I do not want to be in the position of picking a winner in a race. I think both of them are going to win. Broadcom has built an extremely powerful position by manufacturing custom chips, called ASICs, directly for some of the world's largest technology companies. They have a deep multi-year agreement to supply multiple generations of chips to Google, and they recently announced a long-term partnership to build custom AI chip architecture for OpenAI as well. Revenue grew nearly 48% year over year to $22 billion. The AI semiconductor segment grew 78.5% to $15 billion. And operating income in that segment grew 93% on 78% revenue growth, which means margins are expanding. Customers are paying more per unit, and Broadcom keeps more of every dollar earned. Net income is at over 42% margin. Free cash flow margin is nearly 46%. $10 billion in a single quarter, and Broadcom's Rule of 40 score sits at 117, another triple-digit score. With multiple future generations of Google TPUs still on the roadmap and the OpenAI relationship just beginning, the runway here is long. Broadcom and NVIDIA are not traditional competitors. They are complementary. Either way, AI compute spending flows through both of them. The fifth stock is Vertiv Holdings, ticker symbol VRT, and the bottleneck it controls is power. Vertiv does not make chips. What they do is equally essential. They distribute the electricity that makes everything else function. A modern AI data center is one of the most power-hungry facilities ever built. Getting electricity from the grid and delivering it cleanly and efficiently directly to the chips running AI workloads requires an entire ecosystem of equipment. Power distribution units, cooling systems, thermal management technology, and Vertiv supplies that whole ecosystem. Revenue grew about 30% year over year to $2.65 billion. Diversified across North America, Asia Pacific, and Europe. Their backlog, representing future contracted demand, grew 110% year over year to a new all-time high. Free cash flow margin is nearly 25%. Total cash is up over 70%. And one detail I want to flag that a lot of investors overlook. Vertiv's stock-based compensation is only 6% of revenue, one of the lowest figures I have seen in any growth sector. That is a signal about how this management team thinks about shareholder value. They are not diluting you to pay employees. They are running a disciplined operation. As gigawatt-scale data centers become the standard and energy infrastructure becomes a genuine constraint on AI expansion, Vertiv's pricing power will accelerate significantly. This one is earlier stage in that journey, which is exactly why the opportunity is still there. The sixth and final stock on this list is CoreWeave, ticker symbol CRWV. CoreWeave is a data center company, a next-generation cloud provider built from the ground up to host and run AI workloads. The reason this matters so much is simple. NVIDIA can make the most powerful chips in the world, but those chips need somewhere to live. They need physical infrastructure, power, cooling, engineering teams, and software that can put them to work immediately. That is what CoreWeave does. And they do it faster and at higher quality than almost anyone else in the market. An independent research firm called SemiAnalysis publishes a comprehensive ranking called the Cluster Max Report, evaluating every major cloud provider across pricing, speed, chip access, and software quality. In the most recent edition, CoreWeave ranked above Microsoft Azure, Amazon Web Services, and Google Cloud, earning the top platinum tier designation. Revenue is projected to go from around $2 billion to $5 billion in the next year, with CoreWeave consistently beating Wall Street projections. The backlog of signed contracts has grown from $14 billion to $98.8 billion, and these are not short-term agreements. Customers are signing 5- and 10-year contracts because they need to lock in access before it is gone. Meta has committed $21 billion to expand their AI infrastructure relationship. OpenAI and Anthropic are also major customers, two of the best-funded AI organizations in the world. I want to be fully transparent here because this channel is about giving you the complete picture. CoreWeave carries significant debt on its balance sheet. They are not yet profitable on a traditional net income basis, though they are adjusted EBITDA positive. The enterprise value of the business, when you factor in that debt, is meaningfully higher than what the market cap alone suggests. This is a higher risk position than the other names on this list, but when your customers are locking in for a decade and they are among the most financially powerful companies in the world, the risk profile looks different than it does on the surface. CoreWeave is the most direct bet on the physical infrastructure layer of AI, and that layer has to exist before any of the rest of this works. Now let me zoom out and give you the full picture, because I think it is important to see all 6 of these names together as a system, rather than 6 separate bets. You have memory from Micron making sure AI chips can hold and process enough data. You have optics from Lumentum making sure those chips can communicate fast enough. You have compute from NVIDIA and Broadcom making sure AI calculations happen at the speed and scale the models demand. You have power distribution from Vertiv, making sure every chip gets the electricity it needs to run. And you have data center infrastructure from CoreWeave, making sure all of it has a physical home. These 6 companies are not isolated AI plays. They are the 6 pillars that the entire AI economy is built on right now. And every single one of them is experiencing demand that is outpacing supply. The numbers we walked through today, the tripling of revenues, the gross margins in the 80s, the Rule of 40 scores above 100, the backlogs growing at double-digit multiples, these are not projections or hopes. They're already happening. And if AI infrastructure spending even partially delivers on the $3 to $4 trillion annual figure being discussed, the companies holding these bottlenecks have years of this kind of growth still ahead of them. The hardest part is not identifying the right stocks. The hardest part is having the conviction to hold through the noise and stay focused on the fundamentals. That is what we try to help you do at TickerHawk every single week. If this video helped you think differently about how to approach AI investing, share it with someone who needs to see it. There are a lot of people making the wrong bet right now, betting on AI generally without understanding where the real leverage is. Subscribe if you're not already, leave a comment below telling me which of these 6 stocks you're most interested in, and let me know if there's a bottleneck you think I missed. I will see you in the next one.